Hi everyone, in this video we'll be beginning with the chapter number 23 of CMT level 2, analyzing sentiment in the stock market. Before watching this video, make sure that you've checked the previous chapters. In case you haven't, then I've linked it in the description box below. So in this chapter, we'll basically talk about, we'll try to read and try to understand the sentiment which is present in the market and try to make a sense of it. We are going to analyze the impact of the insider activity which is taking place on various types of stocks. We'll talk about what is insider selling and what is insider buying. We'll also see what is short interest and we'll see what is short interest ratio, and we'll also see how to interpret sentiment from the surveys of investors and professionals. Insider activity. Analysts can use sentiment to supplement analysis based on other factors, or they can apply sentiment indicators without considering other factors. It is generally best to use more than one factor, especially when the factors are independent of each other. As an example, sentiment could be used as a supplement to chart pattern analysis. An example is shown in 23.1. Let's see 23.1. So big lots, NYSE big, price chart and insider activities. So you can see this is the price and this is the dates. And here you can see 8 insider buys have taken place. You can see the markouts over here. Now let's read the description of the charts. This is a chart of big lots NYC, a large retailer. Diamonds indicate insider transactions. Buying and selling by insiders can provide insights into their sentiments. So wherever we saw these diamond type of symbols, that shows us that insider activity has taken place. So if you're not able to see it, I'll zoom it. You can see that there's a diamond here, there's a diamond here, there's a diamond here, and here as well. So these diamonds basically show us that some sort of insider activity has taken place in that particular price level and in that particular date. The Securities and Exchange Commission requires corporate insiders, meaning a company's officers and directors and any beneficial owners of more than 10% of the class of the company's equity, to notify the SEC of all the purchases and sales. So if I'm working at a company and if I'm the director or one of the important people in that company, or if I have more than 10% stake in a particular company's equity, then whenever I'm buying or selling something, I need to notify the SEBI before I actually do that, so that why is this done? This is done to prevent any sort of insider activity which can be unfaithful in nature or which can be unfair in nature as compared to the other people who do not have that information which you have because you are working in that company. In figure 23.1, most insider transactions involve buying or selling by just one or two insiders. However, in June 2018, a cluster of buying occurred, this highlighted in the price chart. Let's see that. June 2018, this is June 2018, cluster has been identified. Okay, this insider buying in big came as the stock was consolidating. In hindsight, it is apparent that buying came near the absolute short term bottom. This is an example of how timely insider activity can be. If an analyst was combining insider activity with the chart analysis, the insider buys would not represent an immediate signal. This activity would confirm that big would be a buy as soon as the resistance was broken. So obviously, combining the insider activity with the price action or with the price charts is how you are going to use it. Alternatively, the strength of the signal could be enough to trigger the buy since so many insiders acted within days of each other. It is possible that insiders were waiting to buy until the company announced earnings. Company policies generally restrict insiders from trading before the release of earnings, right? So that is a law by all the companies. Specifics of the policy vary, but the rules are designed to protect the company from litigation risks and to protect insiders from criminal investigation. Since since company reporting policies are generally not public, analysts incorporating insider activity into their analysis must be prepared for reports of selling or buying at any time. Insiders will file initial reports when they assume their position. The initial filing is done on Form 3, which must be filled within 10 days of becoming an officer, director, or beneficial owner. So, if you're working in a company and you have a major ownership in that company, and if you want to deal with their stocks, then you need to file Form 3 within 10 days of you receiving the position. Okay. Subsequently, in ownership are reported on Form 4, which must be reported to SEC. SEC, like we have SEBI in India, SEC of that of the NYSE or the New York Stock Exchange. However, filings can be made as soon as the day of the transaction. Those events are unpredictable, and analysts incorporating this data will need to develop a strategy for timely notification. In addition, those who backtest trading systems that incorporate insider activity should be careful to treat signals as having been generated when the data became available, not when the activity actually took place. So, just because right now you are seeing that here there's a diamond, you can't assume that insider activity is taking place. You receive the information when the thing has already occurred. So, that has already happened. So, you can't, you are anyway having a little bit of lagging data. You need to keep that in mind. Okay. Legal risks also explain why insiders sell in accordance with plans filed by regulators. Securities Commission Rule 10b51 allows insiders of publicly traded corporations to set up a trading plan for selling stock they own. Many corporate executives use plans to avoid any hint of insider trading. The plan is often completed to provide for an orderly liquidation of large positions that allow the insider to diversify a portfolio. Portfolio diversification is just one reason that an insider could be selling. They could also sell to raise cash for personal needs as part of real estate planning, to fund, and so on. Buying in the open market is almost always done because the insiders believe that the stock is undervalued in the open market. However, not all insider buying is done on the open market. Some insiders are awarded shares of stock as part of their compensation. And so, if you're working at a company, sometimes you have bonus, or if you have like a gift, or if you have a salary bonus, they award you stocks, or they award you securities or some sort of futures and options instead of giving you the money itself. Okay, so these are the methods by which you can also get shares. It's not just through the open market. Acquisition of shares at prices below the current price can be an indicator that the insider is bullish and should generally not carry as much weight as buys made in the current market price. Tracking insider trading has been shown to be a profitable strategy. For the reasons noted above, insider buying is generally more significant than insider selling. Although sales are normally a sign of trouble for the company, they can be indicative of a bearish sentiment when multiple insiders are selling large position around the same time. Clusters of activity in which three or more insiders either buy or sell are important signals about the insider sentiment. The size of the trade offers important information. An executive doubling in the position is making a large commitment of their personal funds. So, obviously, if you see that these big insiders are buying something in bulk and many of them together are buying at the same price and during the same time, then you know that all of these insiders are very bullish, which indicates that there is some sort of a bullish sentiment in the market. But if a lot of these people are selling their positions, if a lot of insiders are liquidating and they're selling off their position, that shows that they are comfortable to sell a big portion of their profits, a big portion of their equity, right? So, which means that bearish sentiment might now come and take place. Although analyzing insider activity can be a difficult task, there are potential rewards. It is important to remember that one study found that the purchase portfolio earns abnormal returns of more than 50 basis points per month. About one quarter of these abnormal returns were accrued within the 5 days. This indicates that insider trading provides timely signals. If using the information, it is important to ensure the low latency data sources obtained. The study also found that the sale portfolio does not earn uh, abnormal returns. So insider buying is more powerful. Insider buying is more powerful as compared to insider selling. Keep that in mind. Finally, the study concluded our portfolio based approach also allows the straightforward decompositions of performance by various characteristics. We find that abnormal returns to insider trades in small firms are not significantly different from those of large firms. So, insider activity can also be used in your trading, right? So, look at this. This is S&P 500 ETF for insider buy or sell ratio. This is how it looks like. The ratio of the buys to sells spiked higher in the bear market at the end of 2009. There is 2009. Look at this. Here we have 2009. And we can see that it spiked higher in the bear market, right? So spikes higher are also noticeable, important. Look at the spike in the short terms, 2011 and 16 also, 10, 11 and 16 also. Okay, this demonstrates the usefulness of following insider activity. However, there is no way to know if the level of insider buying has peaked and prices have bottomed. So obviously, that is the reason why we say that insider activity, while it can be a really powerful measure and a powerful tool, but it can't be the only tool which you are using to make your trading decisions. Make sure that this is an add-on and this is something which you use along with various other factors when you are taking decisions. Now let's come to short interest. Another measure of sentiment is short interest. Short selling is the selling of a security that the sellers does not own. By selling before buying, the trader hopes to benefit from a price decline. Obviously, when you're buying something, you expect the price to be high, so you buy low and you sell high. And shorting is basically you sell high and then you buy back the security at a lower price. Typically, a short sale involves the sale of a security at the current price, which is settled with shares lent to the short seller by a third party. The third party can be a broker or anybody. The seller makes short sale on the assumption that the price of the security will go down. If this occurs, the short seller will purchase shares to lock in a profit and replace the shares previously borrowed. Of course, if the stock rises in price, the short seller may elect to close out the position through purchase and absorb the resulting loss. Brokerage firms are required to report their short positions on the 15th of each month, and the exchanges publish compilation of these reports 8 business days later. So one thing you need to keep in mind that the brokers are supposed to provide their data of how much short positions are open, but you need to understand that this data is being published after 8 days. Sorry, after 8 business days. So there is some sort of a lag, right? In those 8 days, a lot of things might have changed, so you don't know about that. Short interest is the total number of shares of a security that have been sold short by customers, and securities firms have not yet been repurchased to settle out the standing position in the market. Just a second. In the market. Yeah. Days to cover. Yeah, days to cover is basically aggregate short interest divided by average daily short is going to give you the short interest ratio. You can remember this particular formula as it can be tested. Let's read about it. Many analysts track an indicator known as days to cover. Okay, it is calculated as the aggregate short interest for the month divided by the average daily share volume. It is known as short interest ratio. So you know now, see, you need to understand the meaning of what is a short interest, right? We know that brokers have a lot of open positions, or whatever open positions they have, which haven't been bought yet, or which haven't been settled yet. Using that, you find short interest. Now, what is the days to cover? Days to cover is how many days are left to cover that particular short positions which are open. Aggregate short interest divided by average daily short interest. Aggregate short interest of the month divided by the average daily short is going to give us the days to cover, or the SI ratio. So the short interest ratio is an indicator of the market sentiment of a specific stock. If the short interest ratio is very high, that means that investors are shorting a large share of companies' outstanding stock, including many investors expect the stock to fall in high price. Obviously, so if my short interest is high, that means that people are interested to short more and more. If the short interest ratio is less, then people are not interested to short the securities from using the shorting facility. This can be interpreted in a contrarian manner. If the short interest ratio is high, traders with short positions will suffer losses if the stock rallies. Obviously, if the SI is high, which means that you think that the price is going to go down. But if the price actually goes up, then you are going to lose the money because the price is going in the opposite direction than what you had initially wished. They may choose to cover shorts by buying shares of the company, cutting losses, and adding to buying pressure in the stock. For this reason, some analysts view a very high short interest as a bullish indicator. Take a moment and read this. Looking at the table which is given below, this is basically an example of short interest. So you have the settlement date, short interest, average daily share volume, and the days to cover. Days to cover is the ratio or the formula which we saw, right? The aggregate divided by the average. Okay. So high levels of short interest can be a source of buying power, right? We discussed that why high short interest can be power. We saw that how people were covering in their positions, right? However, in highly liquid stock, it is possible for investors to use options and other derivatives to establish and cover positions. Figure 23.4 shows that the price action may be affected by the short interest. However, it is important to combine the factor. This is the okay. So you can see the price action of the chart, and you can also see the days to cover. All right, now let's start with survey data. While insider buying and taking short positions both involve putting capital at risk, other sentiment measures use surveys of investors' options rather than actions. Surveys of investors' opinions rather than actions. So, survey is something which is not straight up the thing which is happening, but in fact, it is learning about the opinion which the investors have. A popular and readily accessible survey is conducted by American Association of Individual Investors. This survey measures the sentiment of individual investors. Other surveys track the opinions of investment advisors. In June 2014, the AAI purchased this particular thing. The best contrarian signal occurred when investors were unusually optimistic or pessimistic, but not when the investors were unusually optimistic or pessimistic, but rather when they described themselves as being neutral, defined by the survey expecting stock prices to be unchanged over the next month. Unusually high levels of natural sentiment have been followed by a median of 26-week rise in the S&P 500 of 8.6% and the median of this. Okay. So when people were neutral about some stock, that played out more as compared to when they were either optimistic or pessimistic of a particular stock. The study also noted that large cap stocks were up 83% of the time 6 months after neutral sentiment reached an extreme. A year after neutral readings reached an extreme value, large caps were up 88% of the time. Okay, so let's see this. This is the percentage of bullish advisors, percentage of bearish advisors, bullish, bearish, and this is the price. Okay, this report surveys that the market views of over 100 independent investment newsletters. Okay, you can see this indicator how you use bullish advisors and bearish advisors and how that basically affects the price chart. Nothing important. In figure 23.5, when the number of bullish advisors topped 60%, a market pullback was likely. This indicator rarely identifies market bottoms. Investors' intelligence notes that bottoms occur when at least 55% of advisors are bearish. Okay, so you can see that whenever bullish was above 60, then you can see that the market created a pullback, right? Whenever it was above 60, market created a pullback. So, yeah. That's it with this chapter. In the next video, I will start with the chapter number 24.